What if I told you that you've probably already made a $30,000 mistake and you didn't even realize it? It's not a luxury car. It's not a bad stock pick. It's not even a failed business. It's something almost everyone's, students, employees, entrepreneurs, even. People who think they're good with money. And the worst part, it feels normal. It feels safi. It feels responsible. Dovocimi. It quietly drains your bank account, delays your financial freedom, and steals years from your retirement. In this video, I'm going to break down what the $30,000 mistake actually is, why almost everyone makes it, how compound interest turns it into a financial disaster, and how you can fix it starting today. If you care about investing for beginners, personal finance, passive income, wealth building, and escaping the paycheck-to-paycheck cycle, this might be the most important video you watch this year. Before we start, hit the like button so this reaches more people who need to hear it, and subscribe if you're serious about financial freedom. Let's expose the $30,000 mistake. The $30,000 mistake is simple: leaving your money sitting still, not investing, not compounding, not building assets, just saving. Now, don't get me wrong, saving money is important. An emergency fund is critical. But here's where people go wrong. They confuse saving with investing. $5, $10, $20, sometimes $30,000 or more in a regular bank account, earning almost in 0.01%, 0.1%, maybe 0.5% if they're lucky. Meanwhile, inflation quietly eats 3%, 5%, sometimes more. Your money isn't just sitting there. It's shrinking, and over 10 years. That safe decision can cost you $30,000 or more in lost growth. This is the silent killer in personal finance. Let's talk about compound interest, the most powerful force in wealth building. If you invested $30,000 into a broad stock market ETF, tracking the S&P 500, and earned an average of 8% annually, in 10 years, that becomes about $64,000. In 20 years, over $139,000. In 30 years, more than $300,000. That's the power of long-term investing. Now, compare that to leaving $30,000 in a regular bank account, earning 0.5%. After 30 years, you barely cross $35,000. That's a difference of over $260,000. Read that again. The mistake isn't losing $30,000. It's losing the growth that $30,000 could have created. This is why wealthy people obsess over investing in index funds, dividend investing, real estate investing, retirement accounts like 401ks and Roth IRAs. Passive income streams, because they understand one thing: money must work. So why do smart people make this $30,000 mistake? 3 reasons. 1, fear of the stock market. People hear stock market crash and panic. They remember headlines. They remember recessions. But here's the truth. The stock market has historically recovered from every major crash. Long-term investors who stayed consistent have built wealth. The real risk isn't investing. The real risk is never investing. 2, lack of financial education. Most schools don't teach how to invest in ETFs, how compound interest works, how retirement accounts reduce taxes, how to build passive income, so people default to what feels safe: saving. But safety without growth becomes stagnation. 3, short-term thinking. We live in a world of instant gratification. People focus on this month's bills, this year's vacation, the next gadget, but wealth building is about 10, 20, 30-year vision. The wealthy think in decades. Everyone else thinks in weeks. Let's make this practical. Meet Alex. At 25 years old, Alex has $30,000 saved. He's proud. He worked hard for it. He keeps it in his bank account because he wants security. His friend Taylor also has $30,000. But Taylor invests it in low-cost index funds and contributes consistently. Fast forward 20 years. Alex still has his safe money. Maybe it's grown slightly. Taylor has 6 figures invested. Dividend income. Financial flexibility. Options. Same starting point, different outcome. The difference. One understood investing. One avoided it. This is the $30,000 mistake. There's a financial term called opportunity cost. It's not what you lose. It's what you never gained. When you don't invest, you lose potential stock market gains. You lose dividend reinvestment growth. You lose compounding returns. You lose time, the most valuable asset. And time is something you can never buy back. The earlier you start investing, the less you need to invest. The later you start, the more aggressive you must be. That's why investing for beginners should start as early as possible. Now let's talk solutions. Because this isn't about fear. It's about strategy. Step 1. Build an emergency fund. Keep 3 to 6 months of expenses in cash. That's your safety net. But anything beyond that, it should have a job. Step 2. Start with low-cost index funds. If you're new to investing, choose broad market ETFs. Keep fees low. Think long-term. Don't try to day trade. Don't chase hype stocks. Don't gamble. Wealth building is boring. And boring works. Step 3. Automate your investments. Set up automatic contributions. 401k. Roth IRA brokerage account. Consistency beats intensity. Step 4. Reinvest dividends. Dividend reinvestment accelerates compound interest. It's not flashy, but it's powerful. Step 5. Think 20+ years. If your time horizon is decades, market volatility becomes noise. Zoom out. The long-term trend of productivity, innovation, and economic growth has historically moved upward. Let's address the elephant in the room. What if the market crashes? Here's the mindset shift. Market crashes are not the enemy. They are discounts. When the stock market drops 20%, 30%, 40%, long-term investors are buying assets on sale. The people who panic sell lock in losses. The people who stay invested build wealth. Volatility is the price of admission for long-term returns. No volatility, no growth. The $30,000 mistake is rarely mathematical. It's psychological. It's comfort. It's fear. It's avoidance. Wealthy individuals understand. Money sitting still is dying slowly. They make their money productive. Businesses, stocks, real estate funds, assets that generate passive income. Middle-class mindset, save more. Wealth-building mindset, invest smarter. $30,000 isn't just a number. It represents 1 to 2 years of your life, working thousands of hours, sacrifice energy. When that money doesn't grow, you're not just losing dollars. You're losing time. Imagine retiring 5 years earlier. Imagine having options. Imagine saying no to a toxic job. That's what smart investing can create. Financial independence. Freedom of choice. Maybe you don't have $30,000 yet. It's fini. Start with $100, $500, $1,000. Because the real mistake isn't the amount. It's the delay. A $1,000 investment growing at 8% for 30 years becomes over $10,000. Small, consistent investing beats large, delayed investing. This is how millionaires are built, not overnight, not through hype, through discipline. The biggest financial regrets don't come from investing and failing. They come from never starting, from playing too safe, from waiting too long, from letting fear make decisions. The $30,000 mistake isn't dramatic. It's quiet. It's common. It's comfortable, but comfort rarely creates wealth. Action does. 20 years from now, you won't care about market headlines. You won't care about temporary volatility. You'll care about one thing. Did you give your money the chance to grow, or did you let it sit still? The choice is yours. And it starts today. The second $30,000 mistake that's even worse. Here's something most financial advisors won't tell you clearly. The first $30,000 mistake is not investing. The second $30,000 mistake, lifestyle inflation. You get a raise. You upgrade the car, upgrade the apartment, upgrade the phone, upgrade the vacations. Instead of increasing your investments by $500 a month, you increase your expenses by $500 a month. Over 5 years, that's $30,000 plus redirected away from wealth building. And if that $500 month had been invested in index funds earning 8%, in 20 years, that's over $300,000. This is how high-income earners stay broke. Not that they earn enough, because they scale their lifestyle as fast as they scale their income. If you want financial independence, your investments must grow faster than your expenses. That's a core wealth-building principle. Another version of the $30,000 mistake is delay. I'll start investing when I make more money. I'll invest after I pay off everything. I'll invest next year. Let me show you something powerful. If you invest $500 per month starting at age 25 and stop at 35 just 10 years and never invest again, at 8% annual return, by age 65 you could have over $700,000. But if you wait until 35 to start and invest $500, month all the way to 65 to 30 years, you might end up with less. Why? Because compound interest rewards time more than effort. Time in the market beats timing the market. This is one of the most searched investing principles for a reason. And yet, people still delay. The cost of waiting 10 years, often $30,000 plus, in lost growth minimum. Let's talk about another $30,000 mistake. High-interest debt, credit cards at 18%, personal loans at 22%. Buy now, pay later stacking up silently. If you carry $10,000 in credit card debt at 20% interest and only make minimum payments, you can easily pay $20,000 plus over time. That's $10,000 vaporized. Stack multiple debts. There's your $30,000 mistake again. Before aggressive investing, eliminate high-interest debt. Because earning 8% in the market while paying 20% in interest is financial self-sabotage. This is why smart personal finance strategy follows this order. Emergency fund, eliminate toxic debt, invest consistently, build passive income, miss the order, and you bleed money. Another massive $30,000 mistake, not maximizing retirement accounts. 401k match ignored. Raw fiatages waste. If your employer offers a 401k match and you don't contribute enough to get the full match, you're literally rejecting free money. Let's say your employer matches $3,000 per year. Over 10 years, that's $30,000 without including growth. Add compound interest, it could double or triple. Tax-advantaged investing is one of the most powerful wealth-building tools available, yet millions ignore it. Why? Because retirement feels far away, but future you is closer than you think. Let's expose another costly behavior. Panic selling. Every stock market crash creates two types of investors: the emotional investor, the disciplined investor. The emotional investor watches financial news daily, reacts to headlines, sells during downturns, buys during hype. The disciplined investor follows a long-term strategy. Dollar cost averages, rebalances annually, ignores noise. Studies consistently show the average investor underperforms the market. Why? Because they buy high and sell low. One panic sell during a crash can cost you $30,000 plus in lost recovery gains. The market doesn't reward emotion. It rewards patience. Wealth isn't built from income alone. It's built from cash flow direction. Most people's cash flow looks like this. Income, bills, lifestyle leftovers, maybe wealth builders reverse. Income, vens, bills, life first. Even 10% invested consistently creates momentum. If you earn $60,000 per year and invest 15% annually, that's $1,000 vest year. In just 4 years, you've deployed $36,000 into assets. That's how you avoid the $30,000 mistake. Automation removes willpower from the equation. Let's shift into real estate investing. Some people save for years for a down payment, but keep their money idle while housing prices rise 5 to 10% annually. If home prices in your area rise $30,000 in 2 years, waiting just cost you $30,000. This is why strategic action beats endless preparation. Now, this doesn't mean rush blindly. It means educate yourself. Run numbers. Understand cash flow. But don't freeze forever. Indecision is expensive. Inflation is one of the most underestimated financial threats. If inflation averages 3% annually, your money loses nearly half its purchasing power in about 24 years. That means $30,000 today may feel like $15,000 in future buying power. If your money isn't growing above inflation, you're moving backward. This is why investing in assets like stocks, real estate, businesses, ETFs has historically been essential for long-term wealth preservation. Inflation punishes savers. It rewards investors. Another way people lose $30,000 over time, relying on one income stream, job loss, economic downturn, company restructuring, suddenly income disappears. Building side income streams, even small ones, create stability. Ideas include dividend investing, online business, freelancing, digital products, rental income. If a side hustle generates just $500 a month and you invest it, that's $6,000 per year, 5 years. $30,000 invested plus growth. Multiple income streams accelerate wealth. High net worth individuals follow predictable patterns. They prioritize asset accumulation, tax efficiency. Long-term investing, risk management, strategic leverage. They avoid high-interest consumer debt, emotional investing. Excessive cash, hoarding lifestyle. Inflation wealth isn't built by accident. It's built by intentional financial systems, and systems beat motivation every Jimmy. If you're still watching, you're serious about improving your financial future. Comment below. What do you think your biggest financial mistake has been? And if this video is helping you rethink money, hit the like button. It tells the algorithm this is valuable personal finance content. Subscribe if you want more videos on investing for beginners, stock market strategy, passive income ideas, financial independence, early retirement, wealth mindset. We're building smart investors here. Here's a challenge. For the next 10 years, invest consistently. Increase contributions with every raise. Avoid panic selling. Ignore short-term noise. Do that, and your financial life transforms. Miss it, and the $30,000 mistake becomes a $100,000 mistake. Time magnifies everything. Both discipline and procrastination compound. The $30,000 mistake isn't dramatic. It's subtle. It's sitting in low-yield accounts. It's lifestyle inflation. It's delay. It's fear. It's debt. It's ignoring tax advantages. It's emotional investing. And almost everyone makes it at least once. But here's the powerful truth. You only have to correct it once. One decision. One account opened. One automated investment. One mindset shift. That's how financial freedom begins. 10 years from now, you won't remember the fear. You'll remember the moment you decided to become an investor instead of just a saver. The $30,000 mistake stops today. Your wealth-building era starts now. Here's another uncomfortable truth. Some people don't just make a $30,000 investment mistake. They make a $30,000 income mistake. They stay in a job that underpays them for years. If you're earning $60,000, but your skills are worth $75,000 in the market, that's a $15,000 gap per year. 2 years, there's your $30,000 mistake. And that's before investing the difference. Career capital is financial capital. Increasing your income through skill stacking, negotiation, certification, strategic job, hopping, building an online brand is one of the fastest wealth building strategies available today. High income plus smart investing equals accelerated financial independence. Low growth plus fear equals stagnation. Let me ask you something powerful. If you calculated your net worth today, would it excite you or stress you? Most people track followers like subscriptions, trends, but they don't track assets, liabilities, investment, growth, passive income, progress, net worth. Tracking is one of the most underrated personal finance habits. When you measure it monthly, something shifts psychologically. You stop consuming. You start accumulating. Because what gets measured gets improved. And improving your net worth by just $2,500 per year over 12 years. That's $30,000 in asset growth before compounding. Small, consistent financial wins create massive long-term results. Here's the real transformation. The $30,000 mistake isn't just about money. It's about identity. Are you someone who spends first and invests later? Or invests first and spends what's left? Are you someone who reacts to financial fear or follows a long-term investment strategy? Building wealth requires a new identity. I am an investor. I am building assets. I think in decades. I delay gratification. Once your identity shifts, your behavior follows. And when your behavior changes, your bank account eventually reflects it. This is how generational wealth begins. Before you make your next financial decision, ask yourself, is this building an asset or increasing a liability? Will this decision grow my net worth over 10 years? Am I reacting emotionally or strategically? Is my money working right now or sleeping? What would financially disciplined me choose? These 5 questions alone can prevent thousands in avoidable mistakes. Financial literacy isn't about complexity. It's about clarity and consistency. Imagine it's 2036. You open your investment account. You see 6 figures. Maybe 7. You realize the moment everything changed was when you stopped making the $30,000 mistake. Not because you earned millions overnight, but because you stopped leaking money through inaction, fear, lifestyle, inflation, poor financial habits, emotional investing. The truth is simple. Wealth building is predictable. Financial freedom is systematic. Compound interest is patient. And time rewards the disciplined. You don't need a lottery ticket. You don't need crypto hype. You don't need day trading signals. You need consistency, long-term investing, smart money management, and the courage to act early. If this video shifted your mindset even slightly, do 3 things right now. Like this video to help more people avoid the $30,000 mistake. Comment "No more mistakes" if you're committed to smarter investing. And subscribe for weekly breakdowns on investing for beginners, stock market strategy, passive income ideas, building multiple streams of income, financial independence, and early retirement, because the biggest financial regret isn't losing money. It's realizing you could have built wealth, but waited too long. Your future net worth is being decided by today's actions. Make the right move. Starting now.